Hello everyone, welcome to Tuesday. Today we had a flat day. The market actually opened up and then filled back in and ended up down slightly. I like talking about the S&P 500. It's my favorite index to follow, and we use it in the portfolios. And so the S&P 500 hit a peak on the 19th of February, and by the 23rd of March it was down 35%. And we've now had a 24% rebound to today's high, which is a really, really big move. And in that move, we have seen small stocks and mid-cap stocks and some of these more aggressive stocks actually do better, which again is a bit surprising. That shows that people are feeling very confident in what this move represents. The problem is that in order for it to continue, we'd be looking at what's called a V recovery. So at the end of 2018, we came down 20%, and then we came back very quickly by the beginning of 2019. That's a V recovery. Very unlikely that this is going to be a V recovery, just because of the economic damage that has been created. And the biggest concern that I have is just the visibility of how much damage there is. We are going to see over the next few weeks some earnings releases, and the expectations are all over the board for what the companies will be reporting. And so there's no visibility yet. So I would be cautious to get too involved in this uptrend. We have participated. It's why we stayed in. We've made money in this recovery. Our accounts are down a lot less than they were, which is great. We do have a more defensive position than we did, so if the market does continue down, we will have some good chance to do better in that down market, and we can get more defensive, obviously. So that's what I see at the moment. Let's wait and see what happens as things go. We are reaching a point where I think we're going to start to see some trend develop one way or another. Have a great day, keep safe and healthy, and I will talk to you tomorrow. Thank you.